Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden language of corporate filings. And today we are diving into PayPal's latest quarterly report. And let me tell you, there are some interesting shifts happening behind the scenes that might just surprise you. Get ready, because we are about to unpack their financial story and see if PayPal is still flying high or if it is facing some headwinds. Stick around, and of course, if you appreciate getting straight insights from corporate documents, make sure you are subscribed and join our Discord community linked in the description below to connect with fellow financial sleuths. Alright, let's jump right into the nitty-gritty of PayPal's financial situation as of the 30th of September 2025. They are showing us a big picture of their assets and liabilities, and it looks like cash and cash equivalents have jumped significantly from just under $67 billion at the end of last year to nearly $9 billion right now. That is a pretty solid increase, but notice how their short-term investments have drastically dropped from over $4 billion to about $1.7 billion. If you are a savvy investor, you might wonder if they are cashing out of some investments, or if this is just a temporary shuffle to boost their ready cash. This could mean they are preparing for something big, or perhaps shoring up defenses against economic uncertainty. Looking further down the liability side, we see that funds payable and amounts due to customers are up from about $39.7 billion to over $40.6 billion. This is a crucial number because it shows how much money PayPal owes to its users and merchants. Now, their long-term debt has also seen a considerable rise, going from nearly $9.8 billion to over $11.2 billion. Alien dollars that increase in borrowing definitely catches the eye. It could be to fund their growth, or maybe to manage immediate cash needs. Either way, it is a big number to keep an eye on. Now, for the part everyone cares about, the bottom line for the 3 months ending the 30th of September 2025, PayPal brought in nearly $1.25 billion in net income. That is a healthy jump from about $1 billion in the same period last year, and for the first 9 months of the year, their net income soared to almost $3.8 billion, a solid 25% increase. From the previous year, these are good signs, signaling that their core business is performing well, despite any economic jitters. Let's break down where that money is coming from. Their transaction revenues, which are the fees they earn from processing payments, saw a 6% rise for the 3-month period and a 3% rise for the 9-month period. This tells us people are still actively using PayPal to send and receive money. But here is where it gets interesting. Their Braintree product, which is used by bigger merchants, saw a slight dip in transactions, even though the overall value of payments, TPV, actually went up. This suggests that while more money is flowing through Braintree, fewer individual transactions are happening, perhaps due to larger deals or a shift in how merchants are using the service. But on the flip side, their revenues from other value-added services like interest and fees from their loan portfolios and partner revenues have seen a significant boost, especially for their loan products. That is a 15% jump for the 3-month period and a whopping 16% for the 9-month period. This suggests PayPal is becoming a more significant player in offering financial services beyond just payments. Now let's talk about the costs of doing business, especially when it comes to losses. Transaction and credit losses have unfortunately shot up considerably for the 3 months ending the 30th of September 2025. These jumped by a staggering 37% compared to last year, and for the 9-month period it is a 32% increase. This is a big red flag. People are still using PayPal, but it seems more transactions are either fraudulent or credit-related losses are climbing. This definitely impacts their profitability and shows a growing challenge in managing risk. Looking at operational costs, customer support and operations expenses saw a small 5% increase for the 3-month period, but actually decreased by 4% for the 9-month period. That is interesting. It might mean they are getting more efficient in handling customer queries, or perhaps they have scaled back some of their support operations. The sales and marketing expenses, however, took a noticeable jump, particularly for the 9-month period, a 16% increase. This suggests they are investing more heavily in promoting their brand and services, which could be a sign of confidence or perhaps a response to increased competition. And then there is the restructuring and other category. This part has seen some big moves. For the 3-month period, it went up by 10%, but for the 9-month period, it dropped a significant 35%. This is likely tied to their Q2 2025 plan, a major initiative to re-engineer their technology infrastructure and optimize their workforce. They are expecting considerable cost savings from this, but also incur ring-associated expenses. These are large-scale changes, potentially reshaping how PayPal operates for years to come. When we look at cash flow from operating activities, it actually declined by 20% for the 9-month period. Compared to last year, this is a bit concerning. Even though their net income is up, the cash generated from their day-to-day operations is down. This could be due to changes in how they manage their liabilities and the growing impact of transaction and credit losses, which eat into cash reserve. On the investing front, though, things look brighter. Net cash provided by investing activities increased significantly by $1.9 billion mainly because they saw a large increase in maturities and sales of investments. This means they are likely cashing in on some of their investments, which could be a strategic move for liquidity or to fund other initiatives. Financing activities show a decrease in cash used, which is generally a good thing. This is largely due to shifts in funds payable and amounts due to customers, and also a reduction in borrowings under financing arrangements combined with repayments. It suggests they might be relying less on external financing for now or managing their debt more effectively. Now let's touch on foreign exchange risk. PayPal does a lot of business internationally, and currency fluctuations can really impact their earnings. They've got a strategy to manage this using foreign exchange contracts, but a hypothetical 10% shift in currency rates could still lead to significant impacts on their income, before taxes, especially on those unhedged portions. Then there are their strategic investments. These are a big part of their portfolio, and frankly they come with a lot of risk. A hypothetical 10% adverse change in the value of these investments could mean a loss of around $160 million for them. It's a volatile area and they are directly exposed to market swings with these holdings. One of the biggest risks PayPal is highlighting is the potential for business interruptions due to system failures, cyber attacks, or even natural disasters. They actually had a notable disruption in Germany back in August 2025 due to a coding error which led to fraudulent transactions and the subsequent costs associated with that, their rate. Reliance on third-party technology providers also adds another layer of risk. If those providers have issues, it impacts PayPal directly, and they admit their existing insurance might not cover all these potential losses. And of course, there is the ever-present regulatory minefield. They are dealing with numerous government agencies globally who are really cracking down on the payments industry. This includes everything from anti-money laundering to data protection and consumer rights. They are navigating complex and constantly changing rules, and any misstep could lead to massive fines, legal battles, or even the loss of necessary ICE. Answers they are also particularly exposed to evolving cryptocurrency regulations and the risks associated with holding customer crypto assets through third parties. Now, looking at all of this, PayPal is definitely navigating a complex landscape financially. They are showing strong revenue growth driven by increased payment volumes and a growing push into financial services like loans. On the other hand, the rise in transaction and credit losses is a serious concern. They are spending more on sales and marketing, which is a good sign for future growth. But the drop in cash from operations despite higher net income warrants a closer look. The big restructuring plans suggest they are aiming for long-term efficiency, but these come with front costs and execution risk. The company is clearly investing heavily in its future, but the ever-growing regulatory scrutiny and the need to manage fraud and credit risk remain significant challenges. Their strategy to diversify into loans and other services is smart, but it also introduces new kinds of risks that need careful management. All in all, PayPal is a company in transition, juggling growth opportunities with managing the inherent risks of a global digital payments and financial services provider. So what is my take? Well, PayPal continues to be a dominant force, but the increasing challenges in fraud, credit risk, and regulatory compliance alongside the operational shifts from their restructuring efforts mean they are in a tickle phase. It is important to watch how effectively they manage these complexities. The growth in their loan and financial services segment is a positive sign of diversification, but needs to be balanced against the rising credit losses. Alright, that is our breakdown of PayPal's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives into corporate finance. Don't forget to check out our Discord community in the description below. Thanks for watching. See you next time.